Hi, everyone. Welcome back to the Mortgage Heroes Weekly Podcast. I'm Andy.
I'm Brian.
And I'm Will.
You guys, it is our 99th show.
Oh, no way.
Isn't that crazy?
I didn't know that.
I did not know that at
It
all.
is our 99th show, and I had said last week, we're going to have to do something special for show 100, which, by the way, I still haven't thought through thoroughly enough. Do you need to get your pen? Go ahead and get your pen. We're
Celebrate
good.
holiday.
So Brian's going to get his pen while I talk about our 100th show coming up next week. I don't know exactly what we're going to do, but I was just kind of mentioning to someone the other day, I can believe we've done 100.
That's a huge milestone, Andy.
But I can't believe we've done 100.
Yeah, me neither.
That's a lot.
That's impressive.
So thank you guys for hanging with me on this journey and continuing and looking forward. We also just since we last had a show, we also had our newest Friends of Mortgage Heroes episode came out. You guys did a great job with Rich Brocchini from 33 Property Management.
Yeah.
What do you want to talk about? Say about that.
You just got to watch that. I mean, I just watched the replay. I had such a great time.
Yeah.
I mean, it was just nothing but just lots of wisdom.
Yeah.
Humbleness right there with that guy it was just phenomenal. So yeah, I encourage you guys, watch it. I'm going to put it right there on even on my Facebook page. That's how proud of I am of this one.
Yeah, you guys did a great job. And Rich is a stellar guest, of course.
Very.
I mean, he's a top-notch person, battalion chief at the local fire department, and owns a property management company. They're doing really awesome work. So
They are.
So we are at the end of January, guys. So we already, isn't it weird? We already have 1 month under our belt, and it's crazy. Okay, now here we are in February already, and a month is gone, and I'm like, okay, that month was absolute chaos. And no one was expecting it to be as chaotic as it was, yet here we are.
Yeah.
I think that some of the things that we're seeing are really honestly charting the course for what all the major talking points of 2025 are going to be, some of which we're going to talk about today. We got AI on deck. We've kind of beaten insurance into the ground for the time being. We have the Fed rate cuts. I mean, there's a lot of stuff. So.
Yeah, a lot of good stuff that as we move forward, I think this is good information for people to understand and, implement some of this good stuff.
So people already right now are looking at home prices, guys, and we're going to start there today talking about whether or not we're going to see home prices decline in 2025. Do you have a quick take, before we dig into the details? Do you think we're going to see properties decline, Memo?
No. Based on all this based on the article, I agree with it to a certain degree, right? But again, this is not down to your city. Here in San Diego, this is just not going to, I don't agree with that.
Right. It doesn't match what is being said nationally to what we see happening locally.
That's correct. Yeah. But in some other areas, like Texas, Arizona, we are starting to see some of this stuff. So I do get it. Yeah. You know, but then the article states here in New York and stuff that, that area hasn't declined. It's actually, it has to do with simple economics. And I know we discussed this day in, day out and stuff, and we've done this a couple of months ago, but it's all about simple economics, supply and demand.
Yeah, I agree with them. I mean, I feel like we are going to get a lot more inventory this year, but as far as, prices coming down, I think that's a big, that's a big word to say. I think prices might dip in certain areas, like Will said, certain times of the year, depending on, how the rates are doing as well. But I don't foresee them tanking and, dropping 100% a lot of people expect them to or would like them to.
Yes, something Brian Memo and I talked about last week, and we had to put that chart on the screen was the percent of sales price list compared to list price, and it was 98.1%. So compared to list price, final sales price nationwide was 98.1%. So remember, 2 weeks ago, we were talking about how Wall Street and investors are looking at housing going, 20 to 30% overpriced. Yeah. But then you actually look at the data that came out of the CoreLogic part, or Alta, was it CoreLogic or Alta? Well, either one of those. And basically the number did not jive at all with what investors were saying they thought properties are valued. So keep that in mind as we're talking about this today. And the reason I say that is because the median home price reflects that stat. Yeah. So that whole 98.1% sales price compared to list price is kind of what the median sales price looks at. It's looking at, at least it's reporting out that it's at $421,000, and it was really just in the high 420s not too long ago. So it's barely any less.
Exactly.
Barely
inching down.
Exactly.
What's going to make that move?
What's going to make that move is just going to be, for me, the continued of interest rates being as high as they are. It's going to create a slowdown. It's going to create price reductions. They're not going to be major, but they're going to be price reductions. People, again, we go back to the normal seller, right? They're going to treat their home as, this is it. So my home, it should be this much. Right? Where again, we go back to the builder where they're saying it's a commodity. I need to sell that much. So they need to really conform to what's going on. But for a regular seller, I think they're going to see price reduction. And we're seeing that. We're seeing that frequently.
Yeah, I'm in line with that. I feel like, if rates remain at a higher level, we could see, home prices kind of, take those price cuts. But if rates start to come down, I feel like the market's going to determine, depending on the on how many people want a house, that's going to determine the price. And I feel that if rates come down, then that's going to invite more people to be able to afford, and then that's what drives prices up when there's multiple people wanting that same house. But overall, if rates stay high, then we could see some price reductions.
Yeah,
and I think they mentioned in the article it was like 38.4% of homes on the market have undergone reductions, reflecting the current balance between supply and demand.
And I didn't pick it for this show, but I had seen another article in reviewing what we should talk about today, and it was actually coming out of Las Vegas. It was very specific to Vegas, but they were citing how they're running out of room. And so that made me think of San Diego, where we've also somewhat run out of room. And so what we see happening in these places, we don't see those price declines. We don't see the average median or the median home price in San Diego going down as fast as it would in other areas, even when they go down precipitously, because we have that kind of like lock-in effect. And now I saw Vegas kind of out of the corner of my eye, and there was a whole write-up about it. There was a video. They're talking to realtors in town, talking to developers. And I was like, oh, this is interesting. And it made me wonder, like, what other places are going to have this same problem?
Yeah. I mean, you're starting to run out of land. I mean,
what are they going to do, right? They build up more ADUs, build up. I mean, they're going to probably do some version of the things that we're actually doing right now. But the reason I brought it up is because that does put price pressure on what's existing there. So if you're going to stay there and you want to move up, you're going to pay that price for it. Yeah. It's kind of like San Diego. I'm going to say San Diego 2.0, but Vegas has gone through an incredible boom in the last couple of years, but I'm saying there's still more in the tank because of running out of space.
Yeah. And I think it goes perfect with what William brought up last week. Like, when you purchased that property back in 06, 07, when everything was going down. And then now, I mean, you look fast forward into now, I mean, goddamn, like the property appreciated. You're an expert. No, but that just goes to show, I mean, you bought the house, you needed to buy it then. And then now it's like, not many people can get that same house at that same price in San Diego or anywhere near. And I think that's, something that you really have to think about in these like low inventory areas or landlocked areas, because of the fact that if you know that they're not building or they're not bringing out more inventory, then you have to work with what's available, and the lower inventory, the higher the prices. Yeah.
And I'm actually, we work with several investors. We're starting to see that they're having more of an appetite to want to go to Nevada, right? Because their laws may be a lot easier to build things or to just acquire. It's more affordable and the rent still makes sense. So all those things will factor in. And we're just trying to see a lot more investors considering going there. First, it was like Texas, but now we're seeing a saturation there. We had 44% more homes available this year than last year.
Yeah, and to Brian's point, I mean, kind of in both of these cases, or not cases, in both of these kind of like themes right now, the average the amount of homes that are having a price cut as part of their listing is still right in the range. Like the historical range is 30 to 35%. That was something I remember we quoted in quarter four, and I know I talked about that several times on the show. And so this coming in at the end of 2024 with 33% of active listings taking a price cut, that's like par for the course. So there's nothing like there's no sky is falling. It's not crazy. And again, I know that it's also going to be very specific to the region you live in, but look at the national average. That does, for me, indicate that there's some stability. Now, bad news for people waiting for a crash, you're going to be waiting.
Yeah.
Again, unless there's some black swan, unforeseen, crazy economic or finance event that would cause a complete disruption, you're just going to be waiting. But also for people that are having the affordability crunch, well, you're going to have to come up with another solution.
Yeah.
In order to get into that affordability, if we don't expect that we're projecting to see house prices decline.
Yeah. Well, bringing that says of the affordability, it says here, I love the article how it goes, home prices changes over the past 5 years and hopefully over the next few years. Incomes are climbing faster than home prices. When that happens, affordability improves. Guys, I don't see incomes increasing that much. I mean, we see the medium income in San Diego was like $85,000. Yeah. And it's been there for I don't know how many years now.
It really depends on your career and your industry and your job type. I mean, because there are so outside of California, there's places that don't have $20 an hour minimum wage. Yeah. So for them, going from 13 to maybe 18 or 20, that would be pretty statistically significant. But for us, that's not as statistically significant, because going from 20 to 25, okay, yeah, that might work. But in California, that doesn't work enough. Yeah. You got to get to like $35 and $40 an hour before you start really thinking about, okay, I'm going to go get a place.
Yeah. I hope your partner's in the same boat.
Well, so I think in that example, in other parts where maybe you can still get in for 300 somewhere or 350 even, going from $13 an hour to $15 an hour to 18 to 20, that's going to make a substantial change.
Yeah, it can. And, now it's actually taking two incomes.
Yeah, and I mean, but
those are facts.
What I could take from this is that if we know that, rates are going to be holding, rather in the levels that they're currently at, we see 26% increase of inventory from previously last year this time. I think we can make an informed, this prediction that, we could see some market stabilization based on the information that we do know right now. And we could predict based off of that if we know higher rate inventory, more inventory is coming out. So I feel that there will be opportunities. It's just not going to be in the way that, affordability is going to drop enough for people to be like, hey, we can all buy a house now.
Yeah, and the other thing that I do agree here strongly with this article is price reductions are more common, and they are. They're very common. I mean, I like to use some examples. We just got one where a month ago, one of our clients got into an escrow. The purchase price was $455,000, and the seller gave them a $10,000 credit towards closing cost. Fast forward a month later, that client actually he got PCS orders, so he decided not to buy in San Diego. Oh, wow. He's going elsewhere. And the listing agent gave us a call and said, you guys had already done the appraisal. It came in at $455,000. Can you guys just help this client out? So they send us a lead. Happens to be a veteran too, which is pretty cool. She drafted up the purchase agreement, gave him $20,000 off the sales price, and gave him an additional $10,000 towards closing cost.
Wow.
That's pretty cool.
That's awesome.
So that right there just shows how much spread the seller has to be able to, make the deal work. Yeah. And I mean, that's $30,000 just in general that they basically, worked in the favor for the buyer. And you start to think, well, hey, if we know that, now the price reductions kind of make sense if we're dropping that much, because the seller can afford to take that hit and still be well within their margin of profit that it makes sense for them to
exactly. So that's when you kind of see like, oh, okay, there is those margins. Yes. Those things are, right? A lot of times the sellers are just going to be very stubborn to their sales price until the real seller sees that, no, I need to get going to, my next destination. So I just have to, deal with this.
And it's probably fair to project into the rest of 2025 that if we do continue seeing listings increase, we do see more inventory come on the market, then we'll probably see a proportionate amount more of this same thing you're talking about, where because prices of homes have risen so fast in the last couple of years and stayed, anyone who has that equity and hasn't tapped into it, they can make those modifications. They could make those concessions, and they go, you know what? Okay, I was only going to give a $10,000 credit at first. Now I'm going to do a $20,000 price reduction and still give the credit. Like that says something not only about the motivation of the seller, the circumstances, maybe their timing, but also just the tolerance they have in their, let's say, their net sales profit to be able to like walk away and be like, you know what? Yeah, I'm still cool with that too. So I think actually that might be a forecast of what we could potentially see more of.
Yeah. I mean, every offer that we've been seeing right now, people that are taking advantage of this market and saying, hey, by the way, if you guys get approved right now, pat yourselves on the back. Like really pat yourselves on the back. People who are getting approved to purchase a home, take your time, find the right property. But if you're getting approved, I am applauding you. I am patting you on the back, and you should too. Because it's pretty awesome, and congratulations.
Yeah, and you know what, that reminds me of something like, I have some buyers, and we talked about them buying at the end of the last year and into this year, and I spoke with them this last week, and they're like, hey, we feel a little discouraged because it's pretty tough out there, and I'm like, there is minimal inventory. It's not going to say, hey, like things are going to, get better right away. But what I did tell them is you got to look at it from this point of view. January, December, even into February, March, we're still in the slowest times of our market. So a lot of the inventory that you're looking forward to won't pick up until, around, springtime. So right now, if you're out shopping and you feel like, hey, I'm not finding my spot, hold your patience because the opportunities will come. And right now we're still thawing from the winter. So as we go into the spring, we're going to see a lot more inventory come out. So, hey, heads up and keep pushing.
Not only that, we started 2025 with a lot of devastation out there.
Events all over the place.
So that doesn't help it.
Yeah.
Fires, floods, freeze.
And even with that situation, new listings are up from last week, 13% more than this time last year, and you have inventory climbing for 3 straight weeks in a row. So both those to me are positive signs, and if I'm going to, forecast what I think is going to happen in 2025, I think we're going to see more of that. Partly economics is going to drive that. I know I always talk about situations a lot. Like there's always going to be a death, divorce, or whatever that's going to cause someone to sell or upsize, downsize because of health reasons. I always kind of find myself there, but I honestly think that for a number of other reasons, we're going to see a lot more inventory come this year.
No, absolutely.
Yeah, no,
I agree.
Yeah,
I agree.
100%.
Okay, guys, we're going to move on to the next article today. This one comes from Forbes. So Brian found this one. This is real estate bridging finance. The new star of alternative investing.
Yep.
So I know you guys have this conversation a lot, and this is kind of one of those things like on the periphery of what I read about and what I talk about. So I wanted to make sure that the audience gets to hear from you directly about what this is, how to best apply it, what are the situations you'd be looking for, or maybe this is the best way to finance your situation. So can we start talking first of all about, let's explain to people what bridge financing is, and we'll start talking about some of the benefits of that.
Yeah. So, I mean, in the most simplest term, I think, I didn't know that there was this many different names for bridge financing.
Yeah.
I know it as hard money, private money lending. Some of them call it mezz finance. So I'm like,
Yeah, I
okay,
never heard that word.
Never heard that one before. Exactly.
Short for mezzanine finance.
Oh,
yeah.
There you go.
Mezzanine,
And
yeah.
I'm going to write that one down. I'm going to use it later.
Yeah.
What it essentially stands for is just a alternate way of financing an investment property, not going through the conventional route being, you go to a regular bank. A lot of these products are used in short term and are specifically just for investment properties.
Yeah.
So it's a financial tool you use for a short term period to be able to get in, refix a house or hold it for a rental and be able to profit off of it. So in the most simplest term, it's for investment financing.
Yeah, most people don't know that this is a great tool to utilize to secure a property that you've identified and you haven't sold yours. So you're essentially utilizing your equity to bridge the financing into that new purchase, which is pretty awesome to do, right? And so it just doesn't stop there. And the cool thing about the traditional way of doing things, the funds come to you much faster. The qualification is much faster. Most of these you don't need income qualification. You don't need to show tax returns, W-2s, because it's an asset-driven, investment, which makes it a lot easiand
Yeah. And then two of the most typical scenarios that you're utilizing these types of financing for is going to be your fix and flip. When you buy a house, you turn around and sell it for a profit after you made those, additions or rehabs. And then there's the other one where you do the exact same thing, but instead of the end game being a resell or selling for profit, you're actually going to retain that property, turn it into a rental and get some renters in there and then recuperate your investment like that. So there's two different routes, and those are one of the most, two of the most, how do I say it, popular ones that, you utilize when utilizing this type of financing. And then the other one, like Will said, is when you need to bridge your financing from one sale to the other, therefore you're bridging it from your old sale to the new loan that you're basically bringing in.
Yeah. No, it's a pretty cool tool.
Yeah.
Everything has its pros and cons, right? Like anything in life. Again, the pros are that you have fast financing, you can secure an asset, that you identify without having to sell your home. They'll essentially give you a loan on your current equity to borrow against the other property. Meanwhile, you're going through, the financing of the regular financing for that next property. So it's not always just for investments. It's for owner occupancy as well. And then it's got flexible terms. A lot of times you can choose to go interest only.
Yeah.
Right? You don't have to go with the principal and interest because it's going to be a short-term loan. Those are the cons right there. The cons is it's a short-term loan. Usually it's going to be only for a couple months. The other thing it could be, it's going to be higher interest rates, because we are borrowing you the funds without really seeing your repayment. The repayment is more collateralized of what your home is worth. So the interest rates are going to be, it's going to be a lot higher because there's more risk. And then, things don't work out. There is a possibility that you could lose the asset if your exit strategy isn't in place correctly.
Yeah, and then one of the things that I'd want to highlight is that on average, the people that are utilizing this type of financing is going to be, investors or people that are constantly, able to take that leverage and know that risk that they're getting themselves into, because obviously every loan that's get written is a risk-based factor how they approve it. So a lot of these people understand the leverage that they're putting themselves into, but that's the beauty of it, that they're able to take that leverage, OPM other people's money, and be able to utilize it to, quote unquote, arbitrage the difference between what they're currently doing and then the sale of the project.
Yeah, it's pretty wild.
Well, and I know that this is one of those things that at least common right now here in San Diego is people are doing this because they're building that EDU, they're doing the garage conversion. Now, I know that there are cases where, or I don't know if this is a tried and true rule, so you guys have to clarify for me, but if you want to do like construction, it's not the same as a construction loan if you're living in it versus you're going to be building something that's an investment. So is that always, or is that only on in some occasions, in your experience?
Can you repeat the question?
Yeah, is it because because
I'm sorry, I was looking down trying to think exactly.
What I was saying is, the construction financing is different than this, because I think what gets confused sometimes, and I've kind of seen some comments about this. That's why I'm asking the question this way. Is for anyone who's watching just this segment, when you're looking at bridge finance, it's not the same as construction financing. In an ADU situation, you might be using those funds to construct something, but it's not ground up on land, and there's no structure.
And that's a great question. Here's the thing. This bridge, because it's short term, right? It's usually going to be 6 months to 12 months. Construction, a lot of times with these properties, depending where you're at with the permitting process, very different. So this is going to be more tailored to, like a rehabilitation property. And then you have if it's owner occupied, you're utilizing your equity to rehab your property, and then you're just going to refinance it afterwards. Yep. So that's how it'll work in that case. If it's a property that you're looking, very common right now, it's a word used, novations, that people fix the property to maximize the sale, right? They want to maximize that they're going to sell that property for a higher price. So what they'll do is they'll go ahead and bridge some financing to rehab that property, and the exit strategy would be to just sell it.
So I'm going to pose the question to you guys. I know that this is happening a lot right now, conditionally, because of the type of stuff people are doing on their properties. But do you think this is just a fad, or do you think that this is? Meaning, let me phrase it this way: the rate at which you're seeing it being used now, do you think that is going to continue that way moving forward, or do you think that it's just a big blip on the radar right now and it's going to temper off in the near future?
It's been around for decades.
Yeah, I had to say that.
As long as it's been, so it's not a fact.
At the level we see it right now is what I'm saying.
I feel that after 2020, when everybody basically, was stuck at home, fix and flip, and money was very cheap at that moment, a lot of people became, quote unquote investors, and they started getting, these ideas through, social media, people posting stuff that they saw online. And I feel in that sense, that's where it really got more popular, or even, even more active to the market. But I don't think it's a fad, because in the article, they state that, it's been around for, like Will said, decades. And a lot of these people that are going into these communities are fixing and flipping the properties and making the community better. So I don't necessarily believe that it's a fad when there's an investor that says, hey, this is my territory, I'm just looking to make this community better. And they stay in that market because they're able to understand it, they're able to work around it, and by that time they know people that are like, hey, I'd rather just sell it to you or just make business with you because I know you have a track record in this community.
I feel like this should be more common to be able to be utilized, but it's not as easy as it seems, right? So we're probably going to get a lot of calls saying, people, hey, I can bridge loan. But that's not the fact. That it's going to cost you money to do this. And then when you have to sell the property, right? And now you're going to incur more closing costs on that other loan. So a lot of people are saying, no, I'd rather not pay, because anytime this is more private money, it's going to cost you anywhere from 2 to 4 points. Right? 4% of your loan, where the traditional mortgages aren't like that. You have to get scrutinized by submitting your paperwork and all that stuff. So that's why we see here, which is pretty cool. I found very interesting that, we got 10% of people, investors, purchasing properties through a fix and flip. I thought those numbers were pretty damn cool, And so that's it's although it sounds so easy to obtain, a lot of times it's just not, because this, as the article goes through it and we move through it, it's going to also depend on your experience, and so a lot of people don't have the experience of rehabbing. We have ideas, but as we start demoing certain things, we're like, whoa, we just didn't have the right person. You know what I mean? And so that's part of all this equation. You have to show. It's more common when people have a property and they found a property. Let's say they're here in San Diego, and we've done a couple of them where they found a property in Arizona and they have to move, and they don't want to be contingent because they don't want to lose out on that opportunity over there. So automatically, we'll pretty much purchase that property, utilize that equity, and bridge it, put all the down payment here on that next one. It's more common for that.
Yeah. Yeah, and the reason I posed the question that way is because for a lot of people, they're kind of hearing about this the first time. Like, we know it's been around for a long time. You guys talk about it a lot more than I do. You're in the front of it a lot more than I am. But the reason is because I have seen even in just kind of prepping for this topic today, like some people, there's just these misconceptions or these simple misunderstandings because we don't really get down to the core of talking about it until we talk about it, until someone's on the phone with you or they're in the office and you're actually explaining this to them. So I wanted to make sure that we had a time here to actually kind of explain some of these things. And also, this is a huge market. Just kind of my final thought on this is, I think I read here, like back in 2012 was the latest, or 2022, sorry, was the latest number I saw, like $130 billion of bridge short-term finance. That's a ton of money. That's a lot. Yeah. And if that accounts for 10%, that also reflects how huge the mortgage market is as 10 times bigger than that 130, which is 1.3 trillion, right? Yeah. So 130 billion is a lot of money to lend this way. But it's obviously lucrative because the lenders are making their money, they're making their spread, and they're happy.
Of course.
And the borrowers, as long as they're not getting themselves stuck in a foreclosure situation, they're getting out of it what they need to.
Yeah, this is a great alternative. Yeah. And we're starting to see this a lot more. Whether you call it bridging or you're doing a fix and flip loan, it's pretty much you're bridging, what you can in financing, alternative financing. So, which is pretty cool.
Well, guys, our next article is from CNBC. This is about the Fed, and I want to talk about this. Wall Street still sees 2 rate cuts this year, but conviction is getting weaker. Obviously, going to the end of the year and then coming out into January, having the inauguration, the Fed gets really quiet. It's also this season of year where all that aggregate data from the end of Q4 and the end of 2024 is kind of being finalized, and they're dotting their I's and crossing their T's, all this stuff. You have final inflation readings, you have GDP readings, you have end-of-year non-farm payroll and unemployment stuff, and everyone's looking at, okay, well, did they gauge it right or did they gauge it wrong? And there's lots of varying opinions, but I have some graphs we're going to put on the screen here, but let's just talk first of all about what the heck is going to have to happen for the Fed to actually drop rates. Do you think it's going to be policy pressure, political pressure? Do you think it's going to be data and numbers? What do you guys project is going to be?
I have the answer.
Do something or don't do something.
I have the answer.
What is it?
It's Trump. He already said it. He already told them, you got to freaking control inflation. How did you get us here? You got to stop that. So there you go, Trump doing it again.
So then the translation is they're going to leave rates to try to control inflation because by reducing them, inflation would get hotter? Is that what you're saying?
And obviously, listen, audience, you guys are going to hear this, that Trump already demanded that interest rates go down, that we control inflation. We already know that he's not going to be the determining factor, okay? He could influence somewhat the decision, but he doesn't control that.
But the technical argument is that low rates cause high inflation. So it's like, how can we have both things working at the same time? And I understand we've had pockets of that where it's like, how come inflation is going up at the same time that rates are going up? But there's nuances to all those things. I'm not going to go in the rabbit hole about all that. Yeah. So do you think that then what you're saying is, do you think they're even going to do 2 rate cuts this year? Or do you think it could be like 1?
No, I really feel, again, I'm going to go back to our deficit, all these things. It's going to be detrimental for our federal government to actually do these rate cuts. They're going to need to do it. It's going to happen. So if I'm going to look at this,
you mean if they don't do it because of how much they have to refinance?
Oh yeah, exactly. I think it's just not going to be in their favor. I really feel that there's going to be 2 rate cuts. I'm going to go with it.
Okay.
We just started the new year. All these policies are coming into effect. The whole tariffs and all these things. We don't know what that's going to cause, what ripple effect it'll have, and it's just going to take some time.
Yeah, and I think these last couple of meetings, the Fed had hold still on that. We're data dependent. We're going to follow data, but with what Will said, we know Trump is pressuring, and he's going to be making his advances and saying, hey, we need to get this lower, we need to do this. And I feel that although they won't say, hey, Trump was the one that did it, there's going to be some altering in the data that's going to then bring forth the Fed to say, hey, based on the data, we can now start moving in this direction, dropping rates. But Trump from the get-go is hounding Powell, hounding the Fed, saying, hey, you need to drop it. And although Powell said, hey, I'm going to hold my ground, I'm not going to take anything from the president, they're having conversations behind closed doors. They're going back and forth and saying, hey, I need this. And at the end of the day, Trump loves to make deals. So when a deal gets, brought forth and it makes sense for everybody, I think that's when they're going to come out with the data now makes more sense and we can, bring rates down.
Okay, so I'm going to tell you guys the backstory, and then I'm going to ask you your opinion on what you think is going to happen. So I'm going to tell you what the story was, I'll tell you what I said, and then you tell me what you think, okay? So we have a past client of ours who's also a friend of mine who at a family gathering the other day was like, hey, so what do you think is going to happen with Jerome Powell and President Trump? And I said, well, it's going to be one of 2 things. And that's just my kind of knee-jerk reaction. So, I didn't really think it through too much, but I'm like, okay, like if I have to answer right now on the spot, and here's what it is. he's putting this public pressure on Jerome Powell that Jerome Powell's going to respond to by either digging his heels in and holding on his policy statements, or he's going to have to cave to, which is going to make him look bad, and that the government does influence the Fed, which they say they don't. Okay, so there's kind of one angle. If Jerome Powell holds his feet and rejects the pressure coming from the president, then the president's going to have the ball in his court, and he's going to react in some way, maybe firing Jerome Powell or suggesting he get removed, and that's going to look politically potentially bad, right? So I said they're playing this massive game of chicken right now, and I don't think that the first one who flinches is the loser.
Yeah.
Because I think that because there's so much data behind it, and there's just so many things flying out of the White House every day right now. It's taken us a really long time to get here. It's going to take us a while to get out of it even still. So I said, I think they're playing a game of chicken. I said, I don't think either one is going to want to flinch first, but I think it's going to be the Fed that's going to flinch first. Yeah. Okay, so that's what I said. What do you guys think?
Yeah, I think you're right on
I think 100%. Trump's he's okay.
He's going to hold his ground.
Yeah, he's okay continue grilling and holding his ground because he's coming in with all this momentum, whereas Jerome now has the momentum. I mean, the pressure from the past presidency of like, hey, why hasn't things changed? Now we're into this new presidency. We know Trump's pushing for it. Powell, what's going on with you, bro?
That's it. All the pressure's on him. You've been there for 4 years. How do you fix this?
And Trump's coming in with fresh ideas.
Yeah. And Trump already had told him, even prior to the presidency, like, Jerome Powell's not going to be there. He had already talked. He already had that conversation. I just love how everything is just like they teeter-totting now. When you're asking certain questions in the last Fed meeting, when they're asking Jerome Powell the questions, he's just teeter-totting with the answering that question. He's always just kind of vaguely, So we're going to see on March 19th, next month, let's see if the rate hike, just like you said here, and you're going to post up, there's a 65% chance. I know that was much higher, in the beginning of the year, but now it's actually it's gone down.
Did you guys hear him say soft landing?
Soft landing again.
Did you hear him say it?
No, I did not.
Yeah, it's because he didn't say it.
Oh, okay. I was like, I didn't hear that much. Did I miss it?
Gotcha.
Yeah, gotcha.
That was a setup. So on your screen right now, guys, you see the Fed expectations for cutting. So you see that 65% of those surveyed expect 2 rate cuts this year. 61% expect 1 rate cut. And they expect the terminal rate, the Fed funds terminal rate, to be at 3.4%. We're not anywhere close to that right now. So that seems like a long way to go off on the horizon. I'm not as interested in the probability of U.S. recession, and here's why. I am going to have a bone to pick about this one really quickly, which is they kind of like soft sidestepped the definition of a recession last time it actually happened of 2 consecutive quarters of negative GDP. That's not exactly what it means all the time, and there's actually situations where that could happen, and it's not actually true. Fine, you're going to go ahead and throw away 50 years of saying that economically, and then just for convenience, I can't tolerate the crap. So, will Trump respect the Fed independence that came in at 36%? I don't know. I think this is what Brian's talking about. The president wants what he wants, and he's going to bark about it until he gets what he wants or shuts up. I don't know. But quickly, I want to go to this next one. So this came from Peter Bookvar, which Peter Bookvar has a voice in this argument very regularly with the Fed. And he says, I just don't see the Fed having any confidence right now on how to proceed with rate cuts from here, especially so as we await Trump's tariff and tax policy. Now, some of these things are known. Some of them are not. February 1st marks the date at which some of these go into action, but there's a lot of arguments downstream about, well, who's it going to hurt? Is it going to hurt the country that's sending the items? Is it going to hurt the consumer because it's still going to be imported and there's going to put the tax on the person? I understand the arguments on both sides. I understand the historical explanations of what's worked in the past for tariffs and also where tariffs didn't go the way they planned for certain sectors of our economy. I kind of see it both ways. I don't really have a dog in the fight, but where are you guys with confidence? Like, do you think that? Do you agree with what Peter Bookvar is saying here?
So I just see a lot of just like, let's wait and see. We're 2 weeks into the presidency, and a lot of people are pressuring, going back and forth, saying, hey, that's going to happen, this is going to happen. I got an argument with one of my buddies the other day because he's saying, like, right off the bat, oh, this happened, this is going to do this is going to do that. And I'm like, I really don't know. We are going to have to wait and see. But what I can tell you is that we know what happened 4 years ago, and now we're going to have another 4 years. So I'm like, a lot of wait and see, and data dependency is what they're sticking to a lot. So I think the data is what they're going to be like really holding on to and, hiding behind as their protection to say, hey, this is the reason why we're sticking to where we're at.
Yeah. I mean, I'm just laughing because I see so much of the news. I was watching it. I don't like watching it, but it's just funny. Like, they want results already. Like, why hasn't the cost of food gone down?
Oh, me and him went back down.
Like,
we
dude,
argued about that one.
That was like 2 weeks in. Like,
can I tell you what's so irritating about that is the people asking that question right now didn't give a flying fart about it going up for years straight.
Yeah.
They didn't say, raise their hand and go, how come it's going up again and again and again and again and again and again. They never asked a question on the way up, but now that they want to point the finger, and by the way, I'm not just saying this on a partisan one side of the aisle. I hate it when they do it on both sides.
Oh, 100%.
I hate selective arguments, even though, like, oh, he's making a selective argument right now.
I'm gonna use a quick example. Obviously, we're in the trenches. We're running credits for people. We're seeing what their financial situations are. Even in 2008, when we had the mortgage meltdown, I hadn't seen so many older people going through the financial crisis that I've been seeing today.
Whoa.
You know?
Wait. Don't say that again.
Yeah. I'm telling you, mortgage meltdown was tough. People, we were struggling. These last years, it's been a struggle for a lot of people. Obviously, we have had higher interest rates. You know, people are in fixed incomes, but I haven't been seeing how many people are in their mid-70s to late 70s having the financial difficulties that I'm seeing now. And it's pretty sad because they have a ton of equity in their property, but because their credit scores are so low, there's really minimal options. And then when you talk about these reverse mortgages, because the rates are so high, the terms really don't fit them. You know, so I'm seeing a lot of this right now. I've never seen this before.
I was quickly startled only because, sorry, Brian. I was quickly startled only because you're making a comparison to like the largest economic calamity since really the Great Depression of 1929.
Yeah.
People can talk about the savings loan crisis of the 80s. That's kind of a different thing. But like the whole financial collapse of 08 and 09 was massive. And you're saying right now you're seeing more people in their senior years struggling today than were struggling back then.
Yes.
And
that's my experience
that's a
right
shot
now in the industry.
And I've heard
that's a shot across the bow. That's crazy.
I've heard the conversations you've had, and it's kind of like, you know, it's interesting, and at the same time throws me off because it's like they're so mentally and like emotionally attached to their rate, to their house, to their payment that they're willing to sacrifice. I mean, not sacrifice that to then still keep all their debt, so go through whatever they're going through because of the fact that, no, I can't touch this. No, there's just no way, that's no option. Yeah. When it's like, you're praying to God for help. You're praying to God for that rescue. And like, hey, he's like, hey, here it is. Hey, no, that's not the one I need. No, that's not the one I need. And it's like, you have the tool to literally make all your problems go away, or at least alleviate them to some certain extent. And you're just like, no, that's not for me.
Yeah. It's happening.
Well,
whoever you're praying to.
It does speak that, you know, sometimes behavior and you know, past performance and it's really hard for people to break from. Yeah. And even if you disagree that maybe they shouldn't be as emotionally attached to those things, a lot of people are still emotionally attached to those things, and those become the things you have to overcome in order to help get them see the other side of it. So
so there's definitely help in the horizon. I think everything that we're trying to do right now with the new administration, whatever you guys need to do, just get it done. For me, you know, even though I chose for a certain president, they don't come into presidency. I still have to abide by the rules. I still have to write it out and see what's going to happen. I'd rather be, you know, positive than pessimistic with everything that's going to happen, because we're going to have to adjust either way.
Either way, yeah.
So I want to make sure.
That's my opinion.
I want to make sure, and I appreciate you saying that because, I mean, look, you're the oldest one here. Okay, we've been around the longest, the two of us, but you saying that from that perspective because you are talking to people really matters. It's like extra weight on the scale than me sitting here and saying it, or him saying that. So I appreciate you making that comment.
Of course.
I wanted to make sure that we just touch on this kind of as we segue through. You know, what you see here from CNBC is the inflation impact of promise policies. And this is always something where you hear people go campaigning and they go, oh, we're going to do this and we're going to do that. And then when I'm in office, I'm going to do this. And they go, okay, well, it's, you know, you're pitching me. Okay. Yeah. So of those surveyed, here's what happened. We saw inflation impact, extremely inflationary, only 5%. But here's what I'm saying. Doesn't it feel like it's louder than that, isn't it?
Oh yeah.
The echo chamber is a lot louder than what this says.
Of course.
And
just like me, if I'm gonna have a party, bro, I gotta make it look like it's gonna be a big party, right? Like everybody's gonna come. So, of
And
course.
only 5% show up.
Yeah.
Okay. Womp, womp.
Exactly.
I'm like, wait,
That
that's going to
just
turn out
so
bad
sorry.
if you finish
That just means I didn't promote it right.
I'm so sorry.
Right.
I was just going to stick with the 5% number.
like I thought it was going to be the other way around. Like,
The majority of the respondents said it's somewhat inflationary, and somewhat is really a vague term, but I understand why it's there. I would love for policy-wise, forget the character. Policy-wise, I would love to have some disinflation. Yeah. I think that it would help ease up some cash flow. Here's why I have this theory. I didn't tell you guys I was going to say this. I had this theory that part of the whole removing of the income tax thing is to help alleviate inflation because they privately likely know that they may not actually make a big enough dent in inflation soon enough. But when you remove income tax, you know what that's going to do? That's going to actually fix prices because now all of a sudden people have extra money. They can pay the price that's there.
Yeah.
so you don't have to change anything over here. You're just going to have to adjust something down here.
Right. Because if you can't afford it for $100 right now, Brian, but you either deflate the price to $90,
that's
or
harder to do.
now you have $110 and you can't afford the $100. Do you see what I'm saying?
I like that
so
one.
You might
We'll
have
go
more
with that
money in
one.
your pocket. Well, but then what that does, it just locks in prices. It doesn't have any like fun. I mean, I shouldn't say it doesn't have any, but it functionally kind of like concretes some of our pricing. Even if you change energy, margins can come back for properties, and that's going to be what people who hate capitalism are going to say and all that. So, all right, okay. Last thing here,
You
quickly,
fix
guys.
one thing, you break something else over here.
Yes, is
Economy.
always-
Stupid.
And this is a complete projection, but that's part of this show today. We've got January behind us, and I was telling everyone, hey, we're projecting some things in 2025. So on the promised policies, the effect on real growth came in at very positive and somewhat positive combined 60% of respondents. So 14% said very positive, 46% said somewhat positive, 9% said no effect, which let's say that's neutral. So you have, let's say 69% of these people said neutral, somewhat, or very positive, which I think is pretty encouraging for me, from my seat.
Yeah.
Based on what I'm seeing on these graphs, it just seems like there's a lot of uncertainty, and everybody's kind of like, oh, it's going to be somewhat positive. It might be negative. So it's like no one really knows, but that ambiguity and that uncertainty, it's what's literally keeping the markets at the edge of their seats, trying to figure out, what am I going to do next? How am I going to, is it really going to happen the way it needs to go?
I think maybe this year, Memo, we need to create something new. It's called Brian's Hope Index. And the BHI, Brian's Hope Index is pretty high for 2025. That would be really cool. We have like a hope in it. Because I think you're right. I know I'm teasing you, but I think you're actually right.
I called it when I said there was going to be a little up on rates in December and then come right back down. And it did happen. And I said, hey, I'll be able to get a refinance. I was able to get it. And hey, we went back to where we were at.
Yeah.
7%.
Yeah. Well, any final comments on this one, guys?
No, this is great. I like that article.
Give me my
That's
meter.
a fun one.
Give me my meter.
All right,
It's a fun one. It's a fun one.
Brian's Hope Index coming soon. Our final topic today, guys, is about AI. AI kind of stole the headlines at the beginning of last week.
DeepSeek.
And then, with DeepSeek, I know, we had the tragedy over the Potomac with the airline and the helicopter. That was...
That's crazy.
There's
one after another, guys.
Yeah, I don't want to talk about that in detail, but until that point in the week, AI was taking over the conversation huge. The market took a pummeling when this all came out initially. There was a little bit of recovery, of course. I don't think the recovery is over yet necessarily, but yeah, DeepSeek put pressure on. But specifically today, I want to talk about AI's impact on real estate, which is what this one is from Forbes. Again, Brian, thank you so much for sourcing this article. I want to talk about what people should expect on the good and the bad side of AI helping you in real estate and mortgage. So can we kind of talk about some of these things by section? Like the first one, they said enhancing data-driven decision processes. Would you trust this? Would you not trust this? Let's talk about why we should agree with what we're being told, and maybe we should have some skepticism.
So at least just for me in my life examples, like when I utilize AI, it's because I get instant information on a subject that I don't know or have no knowledge on. And then when it comes to like statistics, information that, I'm really not really good at, AI can in an instant let you know the difference between this, the difference between that, or break it down in an analytical way, in a personal way. So it really gives you that personalized, point of view, that personalized touch, or that personalized experience whenever you're searching or you're utilizing AI for anything.
And that's asking it the right questions, right? I mean, we've had AI for a long time, guys. We've had AI when it comes to Google. It's a Google search. It's just going to send you in the right direction. The only bad thing about that, it just goes all over the place. It gives you ads. It gives you all this stuff. So you're wasting a lot of time. Whereas when you're going to these ChatGPT, Gemini now turned to Proxy, all these good things will actually lead you and guide you in the best direction possible, right? And just like anything else, our cell phones have been AI since forever. Since I remember I used to have that little brick phone or that big phone that it was, man, that thing was a weapon. You know, that thing was a weapon. That thing was like a boomerang, boom, it would come back to you. And then it started with the flip phone, right? And then we started getting, you know, Apple. Well, what people don't understand, AI right now is so new, and it's going to just get way better as you utilize the tool. Our iPhones weren't that great in the beginning. But as soon as we started putting the information into it, it just gets better and better. It starts understanding your algorithm, what you're searching for, what you like, and it just starts customizing to your likes.
I think, you know, bringing it back to like the whole real estate perspective, I think it's a great tool to get started, you know. It's
Absolutely.
a great sort of start, you know, asking the questions that, you know, maybe you're not ready to ask a professional because you're not well informed about it. And then sometimes you're like, I don't know. I don't want to ask a dumb question, so I shouldn't probably not ask it at all. But with the AI, you're able to ask virtually anything you want, however you want, and learn, you know, through whatever way that you're asking, and then say, oh, okay, I have a good enough idea, which I now could build on this, and then go and talk to that professional and not feel like you're getting sold, that you're getting misled, because you have some sort of prior knowledge that you're able to build on to be like, hey, well, I knew that happened, but I didn't know it to that extent.
Yeah. Yeah.
So, Memo, as I was reading through this one, I actually thought of you in this section specifically because of something you've been saying. So, and I know you don't know this, so this is coming out of left field for you. So, by analyzing market trends, neighborhood statistics, and rental demand, AI tools pinpoint opportunities in prime locations. Then the investors can look through the pared down list to best identify which property they want to purchase for investment, helping to maximize returns while minimizing risks. And I thought of you saying about builders. Commoditization. Yeah. It's a commodity to them. It's not their house. And so when there's large amounts of data that have to be I was going to say manipulated. Sorted through. And
that's a good word.
It helps those who's going to just make a math decision, where as long as the math adds up, then I'm going to do the deal. If the math doesn't add up, then I don't. So it's completely unemotional. So I was thinking about you because you've been talking about builders in that way too, where it's a commodity to them. They just want to sell as many as they can.
No, it really is. And it's helping you identify properties based on your exit strategies. Everything's based on exit strategy. It brings rent. It'll bring, you know, what people want in the area, what they're looking for, the traditional type of home that you're going to build. So this is like really good information. You know, if I'm building in downtown Chula Vista, what would be the typical home that you would do, right, from ground up? It will give you ideas. You know, what are the trending things that can go on for, you know, that are not going to be considered historical right away, right? We kind of continue on with the tradition thing. It'll give you all these ideas. And so you just got to ask it the right questions. You can't be very vague with your questions, right? Just like when you speak with your wife, you know, communication will be key. You know, tell her what you want so that she can deliver on that. It's the same thing with AI. As a matter of fact,
hold on. So you're saying your prompt has to be right when you're talking to your wife.
That's right.
Write the right prompt?
Exactly.
Brian's the youngest of our relational experience in the room.
I'm like, I grabbed that nugget. I'm like, wait a minute. Is he dropping?
You can can give prompts in your relationship.
Babe, you're AI. I just have to talk to you right.
That's it. Communication. So when I went, what was it, a couple of nights ago, I was just freaking hungry. I didn't bring lunch to work. So there I go. Tanya, I want a Western cheeseburger. We go to Carl's Jr. and we're ordering. She introduces herself as an AI. I am currently learning, and she says, you know, so please place your order. In other words, it's already telling you, I may have a flaw, but just I'm going to get better as time goes on.
Where was this at?
At Carl's Jr.
No.
Yeah, you know, so when you order, there's no more person there taking your order.
Okay, I just haven't been to Carl's, okay?
Yeah. And, you know, the only thing is, it keeps telling you, is that all? Is that all? And you're just like frustrated. No, I'm going to order more, you know?
Yelling at, no and then.
No
and then.
Dude, where's my car?
But anyhow, what I'm going with this is this is a new thing. NVIDIA, I mean, if you're looking and you guys invest in that stock, is just nuts where it's at. And people doubted that it wasn't going to do that well. It's done tremendously well. And everything as we're going, it's going to be AI. Yeah, is there concern? And a lot of people are concerned that can take over a lot of jobs. It can replace people. Not for certain things. Not for certain things, right? Humans are always going to be needed. What's cool about this is, again, it's a convenient tool for you to utilize. It's a convenient tool for you to learn more. It's a convenient tool for you to be able to explore more things and understand things a lot sooner. I know I utilize it the heck out of it.
I have a handyman friend, Tim, and he's like, you know what? I'm not getting replaced by AI anytime soon because last week I replaced a ceiling fan, a bunch of smoke detectors, and a screen door.
Well, I don't know, Andy. I don't know.
Ain't on robots.
Anytime soon. I said anytime. That's what he said.
Next year.
Yeah, yeah, at the speed of it.
So,
okay.
Hey, someone this week, poised the argument that their goal was to, eliminate the realtor from, the transaction and just in general. And to me, that was a little bit, far-fetched. It's really difficult to, eliminate that part of the industry, which I feel that, at the end of the day, we can go all in on the data, go in on the internet. But in these types of transactions, I feel you still need that trust factor, human interaction with the person to hold their hand so that they can't blame it on the AI, which then turns to themselves blaming it. They can have an exit strategy to say, well, you told me, I trusted you. And in that sense, you can't buy a house. And if the house goes wrong, well, it's your fault. You followed the AI.
I don't know, and I don't know, Brian.
I'm going to meet you right there. So I know what you're talking about, but I'm going to say that that's only for part of the transaction, because one of the things that they're talking about here is the personalized property recommendations.
Yeah, exactly.
So it's fine if you're going to aggregate a bunch of data so that nothing gets missed that maybe a human would miss. So hold on. Let me finish. So let's say that you're looking for a house and you want this specific criteria, and your agent can type that stuff into MLS, and you get the search results and they send you that. Well, if you happen to miss something and the data is in the system and it gets overlooked, or it just doesn't you can't find it or whatever, but it still is there, AI might be able to be a solution for that. I'm not saying it replaces the agent, but I'm saying there's a hand in glove thing here, I think, happening, where the data-driven part of it's going to help agents help their clients, and clients are going to trust that because they're using it in their own personal life.
Oh, 100%. I agree with you 100%. On the contrary, I feel that the agents that utilize and mesh good with the AI are only going to become more valuable because of the fact that they're going to be able to have more capacity because of the systems that they take in place. But the ones that are vulnerable are the other outside, businesses that are connected to real estate that are very data dependent, that are very systematic, that can be, quote unquote, not replaced, but innovated by, implementing AI and having better systems.
Yeah. I mean, check this out. Also, on top of that, let's just add another layer, which is I found pretty cool with this article. But it says AI role in property management and fraud detection. That's freaking awesome, right? When it's telling you AI helps detect fraud, authorized short-term rentals, and zoning violations by identifying suspicious patterns in the data. That's pretty cool. Most people that go into and they want to rent, they can put this information in there, ask the proper questions again, and they're going to get the right rules. AI powered by automation streamlines rent collection, maintenance, scheduling, and tenant communication, reducing administration workflow. Powerful.
I mean,
powerful.
Our past guest was saying how he has all his systems dialed in, utilizes AI to be able to, 24/7 have services.
So then we go to the future impact of real estate, right? AI is improving efficiency across the industry, from customer service to risk management. Come on, guys.
I think there's going to be a large contingency of the pieces of this process that are going to have AI aids or AI replacement for, but it is also going to take time, because to your point earlier, if it's garbage in, it's garbage out.
Yeah.
So what we feed it over the course of teaching the model what to do and why to do it and what scenarios to look for, I'm not going to say thousands. There are hundreds of contingency elements of an escrow.
Yeah.
It could be a broken faucet. It can be, a lien on the title. It could be the name on the driver's license doesn't match the name on the bank account, which is different than the Social Security because it's misspelled. There's all sorts of other things it's going to have to pick up on that we as humans recognize. Oh, it's still the same person, but it's not the same reference to the person. So that's going to be a little more on the horizon, but I think it's really going to help with workflow, possibly. I don't think it's going to reduce costs. I know that's one of the arguments that they're saying that could be good for AI. I think that's just they're trying to pitch this. Here's why. If you can do it for cheaper and you don't have to change your price tag, they're just going to do that and scrape the margin. Oh. I don't trust that people are going to go, oh, we have AI now, so it's going to be only half the price for your title. No, it's not.
We got AI.
They're going to
now.
They're going to charge the same. They're going to charge the same price, because ultimately, I think what's going to happen is until the policy and the rule changes, there's still going to be a licensed person or a person who's got a certification to be responsible for signing off on certain things. Yeah. So there's still going to have to be some, let's say, authority or supervisorial. So is that, what's the word? A supervisor looking over whatever is being done to kind of authenticate, okay, yeah, this is valid, that's not valid, this is valid, this is valid. So there's a lot more I think that has to get shaken out in this whole topic.
I mean, Andy, real estate is evolving fast with AI.
Oh, yeah, that's why I brought it up. Like this one's important because it's going to change what 2025 looks like.
It's going to allow you to do a lot more, like
right?
so
and
much more.
And the thing is, are you keeping up with it?
Well, are you actually asking me?
No, I'm just saying, like, I don't feel like I am. I don't feel like any of us really are. Just the true, like Brian said, there's some people that's what they're driven by and they're utilizing, and you can see them there, top peak of their market, not peak, but they're top of their market.
Yeah, there's something there's a chart that's called the law of diffusion of innovation, and my friend Matt and I used to talk about this all the time. And it's basically a bell curve, and it says like there's the early adopters, and like right now we're in this early adopters. Yeah. Like the first 5% through the door. Like when the big the big flat screen TV came out and they were $20,000, not everyone had them. Now that so anyways, the whole idea of law of diffusion of innovation is that over time a larger and larger part of the population uses the thing. We can look back and look at laptops, iPhones, internet, internet, right? So there's always like those kind of first through the door people. I think that's where we're in that first through the door season right now.
How would it look? Yeah, and how would it look like, Andy, if you can predict the best? If you're a realtor and you can predict the best deals in your market, what would that look like?
The advantage is going to lie in the hands of the people who are understanding what it is and are positioning themselves to figure out how to work with it and not be replaced by it.
Yeah. I mean, we were talking about with AI, one of our friends, close friends, Chris, I'll just say that. Chris, he developed this software and he's been working with software engineers where he does wholesaling, he does rebuilding. He's going nationwide with this platform where he's connecting people's electricity bills and everything into a system to identify homeowners that are not paying certain things on time where they're potentially going to have to be in the market. So he's utilizing AI, predicting the next sellers, which is pretty wild. When I heard that, I'm like, what? How are you integrating all these things to go into this and understanding that? That's pretty powerful.
It's crazy because like you'll have AI generated profiles where when you go sign up for any service or anything, and then they'll tell you, well, based on what you're searching, your habits inside social will be able to generate more or less what you're inclined to, what you're kind of like. And it's kind of like, like, how is it knowing what I'm doing and based off my habits and what I'm doing, it's going to predict that I'm going to not pay my house.
I wonder if we're going to see,
but at the same time, like it's here.
Yeah. I wonder if we're going to see some version of this of Minority Report. Brian, do you know what Minority Report is with Tom Cruise back in the day? Do you remember Memo?
What year was it? And I tell you,
where they predict if you're gonna commit a future crime, and then you get pre-arrested so you don't commit the crime.
You know what? I do know.
So this is the real estate version of it. This is the version of it where they're like, oh, we predict you're gonna have an NOD, so we're gonna.
Sorry, you're denied.
You're gonna list your house now because there's a high chance that you're gonna actually default.
As funny as it sounds, but yeah, absolutely.
That's what I'm thinking.
That's actually right.
I was reading this, and then you mentioned it. I'm like, yeah, you know what? I think that's
because it's like they eliminate the credit score and they just take your whole life profile.
Yeah, I mean, you'd have to create scoring for behavioral models and stuff like that.
There's going to be a whole alternate type of like way of being able to measure and take that.
Yeah. Do you see? I don't know if I should ask this question or not. Like, do you see any like on the surface, like at first glance, do you see any like pure threats of this or not yet?
Of course, there's lots of threats to this, well,
because we're sitting around talking about how it could be helpful in some things.
Correct.
I know I'm bantering,
but that's going to be for the people that take advantage of it. They understand the utilization of how that becomes a resource to them. For people that are just kind of not understanding this and don't want to change with times, yes, that's going to be something that for them it's going to be a scary moment.
I think the threat right now is not learning how to utilize
exactly
AI. Because to his point, down the line when you do want to adopt it and you do want to learn, it's going to be too far advanced to the point where you can't even understand or comprehend it. So I think adopt now, get used to it because it's not going anywhere.
Yeah, my saying is I'm an old dog that likes to learn new tricks. Right? It's what it is. I have to evolve with the changes. AI is evolving, making a lot of changes, and if we're not in it, we're just going to be left behind. And believe me, this thing is changing fast. I mean, a few years ago, and I'm not going to go like maybe 3 years ago or 4 years, I want to say, it was just ChatGPT out there. And now look at all these AI tools that they put for different things.
Every industry has their own AI bot.
When you're reading this, it says, forget endless house hunting, right? And it goes to AI is now matching buyers with their dream homes in seconds. Right? Like, that's powerful right there. That alone is going to make me, where do I go? Where do I sign up? Well, how do I figure this out? And what does it entail for me to do? Is it going to be my name? Is it going to be my income? Is it going to be the area? Is it going to be because I have kids? What schools are going to be important to me? And it's going to be able to match all that up. It's like a matchmaker, right? That's a pretty powerful tool if you really start considering, what it's going to do.
I'm very interested to see what this conversation looks like middle of the year and end of the year, only because of the rate of speed at which things are changing. I mean, you're mentioning it, you kind of like joking earlier, like, oh yeah, well, you're not going to replace today, but tomorrow.
and even with like DeepSeek popping into the picture, I think that's going to just turn on a lot of engines, and people are just going to get ramped up, and it's going to be like they poised the scenario where they're like, hey, this kind of seems like a Cold War where they're putting Sputnik up, and it's like, yo, we're getting there first. No, we got the best AI. No, you got the best AI. Here we go.
Again, let's put a poll out there to our audience: is who's using AI? Just
who's using it and what are you using it for?
Yeah.
So
that'd be pretty cool.
We know what it's doing in our industry, but like, what is it doing in yours? If you want to say what your industry is, or how do you as a person use it, that'd be interesting. That's a good one today.
And here's a better one for you parents: ask your kids that are going to college who's using it.
Oh God. You know what? You might not want to ask.
you do. It's always good to know.
Did
what
you
your
do
kids
the
are
work,
doing.
or did
I found out I'm paying my son's college so he can type a prompt in.
Let me see your ChatGPT history right now.
Come on now. Let's see
God.
that. I mean, geez, these kids are getting they're smart.
Okay, well, more on AI.
Smart has changed
at the end of the year. Mid-year and end of year, guys. Let's wrap this up. What was your favorite part of the show today, Memo?
Mine is AI. It's AI. It helps me out so much in my day in, day out activities. I want to learn how to diversify one of my investment properties. And I was thinking whether I do an ADU on it, since I'm only making $600 on it, I know I could be making more rent, but I've had the same tenant there for an eternity. So I'm just contemplating where to go. And so today I asked it, what are the pros and cons from a DST, right? A Delaware statutory trust. And it broke it all down. It simplified my job. And so now I'm going to go and see this on the 13th of February. I'm going to go with Chris, invited me for a free steak. Thumbs up right there, Eric. But I'm going to go have a stake on them, and it's going to teach me more of it. Now I want to become a better resource, right? Where I can be there for my clients who do have an investment like myself. How would I apply these tools and these resources in my normal life? So again, I just want to be a resource. So mine is AI because it does help me become smarter much faster.
Awesome. Brian, how about you? Favorite part of the show today?
Mine was going to be shedding the lights on the rate cuts and really breaking down what the policies and what people think about the policy and then the effect that they're going to take in in the economy. A lot of people are saying that, hey, it's going to be worse, it's going to be horrible, but a lot of people, based on the data, they don't really know. They're uncertain. So I'm looking forward to really seeing that play out, seeing what comes out of 3 months, 6 months, and then really kind of assessing and saying, okay, based on that information, now we know that we can expect, things to get better, or nothing's getting better. So that was really good for me. I like seeing those graphs.
Nice.
I think you guys are probably expecting me to talk about the Fed as my favorite part of the meeting today, but I'm not. It's going to be AI. It is AI because I have, I think I'll call it a healthy reserve of skepticism about what it's going to mean for us materially. Not because I'm afraid of the company, but what it means for our experience with our customers and how we can use it to help them and not let it run so far ahead that it will not give them the same advice that we would give, knowing them. Because there's people that might, put their prompt in their situation in a prompt, but that doesn't tell the prompt all the years that you've had someone and done 2 or 3 or 4 transactions. More things about their scenario than they may have put in a prompt or whatever. So I still think there's a lot of that's going to get massaged out, and I'm very curious about it. And on my own, I'm studying a lot about AI in this space, in video, in marketing, in content, in finance as well, because there's a whole nother part of this that is touching with banks and with fintech specifically. There's a crypto conversation. So the AI thing really has my antenna high right now. So
awesome.
Yeah. Thank you guys for a great show. I'm actually going to have AI write next week's show. because it'll be our 100th
right.
show. We might as well just go out with a bang.
You
Let
don't need
AI
us.
do the show. It'll be a fake memo, fake Brian, fake Andy. So you can fake hit that subscribe button,
Brian.
fake hit the like button, and fake share it with somebody, or let AI do all the work for you. The three of us will be back again with you next week. You guys, thank you for a great show.
Yeah.
Thank you for tuning in, and we'll see you again next week.
Bye-bye.
See ya.
That was awesome.
So if you enjoyed this video and got value from it, subscribe right here. And if you want to watch another video, click right here.